Hello, friends, clients, and colleagues. This is Rich Siegel, Managing Partner with ARQ Wealth Advisors, and today is Thursday, December 11th. Year's almost over. Amazing. We're going to do a 5 for 10 today, 5 charts in 10 minutes, and I'm going to be with my colleagues, Carl Mariner and William Lee, today to discuss the markets and the economy. So let's get after it. First slide is going to be the yield curve. And with yesterday's Fed announcement of a 25 basis point rate cut, we thought this was incredibly appropriate and timely. And what you'll notice is that the dark blue line shows on the front end of the curve over here, you're looking at about 3.5%, 3.7% Fed funds rate. So look out 30 years, and you'll notice 4.8% for the long-term treasury, and the longer you go, the more you get paid. This is quite different from the dynamic we had just a couple of years ago. What do you guys think?
It's a wonderful start to normalizing the yield curve. It's healthy for banks, healthy for the economy to get back to a place where it's advantageous for banks to lend when the longer end of the curve is higher than the short end. Is generally a positive outlook for the economy. Definitely different if you look at the light blue curve. Everything was lower, longer out, and there was disincentives.
How about you, Carl? What do you think? What are your thoughts?
I have a couple quick thoughts. So the first one is I would just acknowledge it's worth noting for how inverted that yield curve was. We didn't have a recession. Historically, an inverted yield curve like that has been a predictor of recessions. A yield curve that inverted to have skated through it without a recession is worth acknowledging. I would come back to what's important to investors here. We've talked about this a fair amount recently, but as the front end of that yield curve comes down, that really means cash deposits, money market funds are yielding less and less. When you start factoring in inflation, it's pretty likely over the next several months we're to a spot that you're at negative real yields. So holding cash becomes really an unviable investment. I think there's real implications for the rest of the market with that outcome.
That's a great point. It's shocking. If you look at the green line on the chart, look straight up the left side, it was a 5.5. So basically the Fed funds rates come down 2% in the last year and a half, 2 years, which means that the money policy is becoming more accommodative as opposed to restrictive. They raised rates so high to beat down inflation. They got it down from 9 to we're at 3 now. So it's worked. And now it's more of a kind of, precision game. I think the Fed's doing a decent job here. And you can see the dark blue, if it comes down another 25 or 50 basis points, we'll have a beautiful, positively sloping yield curve, as they just said, very positive for the economy as well. So let's move on to the next slide. And this is a really fun one. We'll get political here for a minute, begrudgingly. This just kind of shows historically the first, second, third, and fourth year of a presidential term and what the markets do. And what you'll notice is the second year, we're heading into a second year here, the average return going back to like the Great Depression, 100 years, is only 3.3%. So with that, we need to keep in mind things could be pretty choppy in 2026. What do you guys think?
I'll take the first thought here. So I always come back to the idea that uncertainty breeds volatility in markets. Typically what happens in a president's second year is a balance of power shift. And we're already looking at that. If you look at betting markets today, about a 75% chance that the Republicans lose the House in the midyear. So a lot of what is happening here really is an expectation of some element of uncertainty of what policy might be after that second year. Markets are forward looking. They're trying to price that information in. It's more uncertain. It's difficult to get to some of those bigger returns.
I might just add that if we do get a shift or a change of the guard in the midterm elections, that could lead to more of a gridlock scenario, which has historically been positive for the markets. Time will tell what actually happens, but that's something that we're looking forward to.
Tie a bow on this page, this chart. First of all, the range of outcomes for the S&P 500 over the last 100 years in a second year has been as good as up 45% to down 30%. So very unpredictable year to year. It's also worth noting that this is looking at the S&P 500. Even if the market does return 3.3%, the S&P does, it doesn't mean that foreign stocks or small caps can't return double digits. So I think being diversified into 2026 is the key. Okay, let's go on to slide number 3. And I love this slide. It looks really chaotic. This is a JP Morgan slide. And the long and short of this is, look, all the way to the right, the bottom right corner is a green dot, and it shows December 2025. And what this is showing you is the University of Michigan Consumer Sentiment Index. And historically, it is a contra-indicator of market returns. What you'll notice is really fascinating today, that sentiment is in the tank, okay? Very low. And if you look across history, like for example, if you look at 2021, June of 22, I should say, you'll see a 17.6% return in blue. What that basically means is that when sentiment is at these levels, this low, the following year is really strong for the stock market. Okay, when people are skeptical or nervous, the market tends to do well. It's just the opposite when it's euphoric. That usually signals a top. Anything to add, guys, on this?
I would just say the wall of worry. The more things that we worry about, the often the better the markets do. It's a strange phenomenon, but that's how it's played out for much of the last 20, 30 years.
I love putting context behind this, and I think the most interesting context is acknowledging the market today has a lower sentiment than at the worst of the GFC, the financial crisis in 2008. So if you kind of put that together, our good friend Tom Lee likes to refer to this as the most hated rally. The market's begrudgingly buying equities and following along. Really worth acknowledging that.
And it's kind of, again, it's counterintuitive, but look at the top left box on the chart. In the last 50 years, when sentiment has peaked, those 10 peaks there, the market return over the next following year is only up about 4%. So when people are happy and complacent, it works against you, and when people are nervous, it works for you. So, all right, let's move on to the next chart. This is number 4. Really interesting. So these are different markets. S&P, Morgan Stanley, EFA is Europe, Asia, Far East, developed markets. Japan, emerging markets. Let's just look at this in context. The blue lines are 2025 earnings growth. And the yellow is the forecasted earnings growth for 2026. So we've been talking about expensive valuations ad nauseum for years. However, with expensive valuations, we see a scenario where we're at all-time high earnings growth or earnings levels and all-time high profitability, which really almost justifies higher valuations. So you'll notice here under the S&P, the blue bar, it's saying that for 2025, earnings across all 500 companies blended have grown 11.6% from the previous year. Next year is supposed to be even better, 12.9. But what's really interesting, look at the far right at the EM, emerging markets. And by emerging markets, primarily we're looking at Brazil, Indonesia, India, China, Mexico, right? Latin America. An explosion of earnings growth in the emerging markets area. Same thing with Europe, EFA, 9% versus 1%. What does this mean, guys?
One, there's a lot of opportunity. The thing I come back to is, why is this happening? There's been a lot of policy changes across the globe, both driven by tariffs, driven by wars, a host of reasons. But that protectionist regime or new economies across the globe are really leading to policy changes and a lot of investment across Europe, particularly Europe, Asia, that are going to lead to stronger growth and could be the catalyst for international equities to more materially participate than they have historically.
So you mentioned catalysts. That's a great point. Carl, you want to expand on that? We have catalysts that have really played out this year and looks like may play into next year. You want to cover that in more detail?
Yeah, we're big believers in having a thesis around what may happen, but usually it requires a catalyst to begin that action. So when we talk about an investment idea, we might like value as a theme. Being cheap by itself isn't necessarily an attractive investment option. Being cheap and a reason to buy cheap stocks becomes more attractive. So I would zoom out a little bit here, though, and just hone in on this idea of earnings. We've kind of given a bear case and a bull case for equity markets. So looking at the presidential election, looking at some of the other charts that we've covered, I just acknowledge forward-looking earnings accelerating even from very high earnings levels is a really strong signal, right? One of the things that we're looking for are potentially positive equity returns, but stocks getting cheaper next year because earnings are growing faster than the valuations of stocks.
That's a great point. PE is just a math equation, price divided by earnings. If earnings go up, like if the S&P earnings grow 13% and the S&P's up half of that, 6%, that the E is growing faster than the P, which means that valuations become cheaper. You could have a higher market next year and a cheaper market next year versus where we are today. Fascinating stuff. Final slide, and this really focuses around emerging markets. It's been an area, a point of pain for a lot of investors for the last decade or so. This year, emerging markets have returned double the S&P 500 for several reasons. One of the biggest reasons is they're a huge beneficiary of a weaker dollar. So looking at this chart here, it's fascinating. The bottom line, this kind of gold-colored line, is the price to earnings ratio of emerging markets. And you can see it's kind of dancing around its average for the last decade. Even with today's incredible outperformance, it's still not expensive. Then you compare that to the blue line, which is the S&P 500 price to earnings ratio growing, and it's been quite choppy. You could see during COVID in 2020, it collapsed, then came back, then collapsed again in 22. So we're at pretty high levels here. What do you guys think the takeaway is here from this chart?
I want to come back to the idea we just touched on, which was catalyst. So I think about the emerging markets today, and the story really is cheap valuations that benefit from growing earnings, and the catalyst here is dollar weakening. Dollar weakening has historically been a very strong signal for emerging markets. We put the three of those things together, it creates a pretty compelling investment case for emerging markets right now.
I would just add to what Carl is saying. Why is the dollar going to weaken? Well, if we get the Fed tailwind and they continue to ease monetary policy, that generally coincides with a weakening dollar. So lower rates, lower dollar strength, that could be the catalyst that we're talking about.
And when you looked at the monetary policy in the EU, for example, they were cutting rates about a year or two ahead of us. So their currency got weaker versus the dollar. Now we're playing catch up. We're lowering our rates, and now our currency is getting weaker versus this other basket of currencies. So I agree. In all likelihood, the dollar should maintain current levels or get cheaper. It shouldn't get expensive unless there's some type of global economic shift in 2026. So we've covered the markets, we've covered the rates markets, we've covered sentiment, and what's going to possibly happen next year. I think we covered a lot, guys, and thanks. This has been great. Hope everyone has a great holiday season, and we'll speak to you soon.
Happy holidays, everybody.
Thanks.